David Karp, welcome to the DCQ podcast special sits. It's great to have you on today. How are you?
Thanks, Peter. It's great to see you, and I'm excited to be here with you.
Excellent. So, are you joining us today from New York?
So I am joining you today from Rumson, New Jersey, where I live down by the beach. I have a very interesting commute into Manhattan from here. We take a ferry to the United Nations and I get to depart the boat and walk 10 or 15 blocks to the office, and it's a wonderful way to make my way into Manhattan 4 days a week these days.
Excellent. And so, is New Jersey the state that you grew up, or are you originally from New York or another state?
So grew up in New York. You know, both parents were worked for big banks and in different areas. My mother in merger integration. My dad was a commercial loan salesman. But eventually made my way to New Jersey. Still wanted to commute into the city, but really a great lifestyle here in central New Jersey. Most people think of um, the plants and the industrial type part of New Jersey by the Meadowlands and the stadium, but there's a reason they call it the Garden State.
Okay, but you are born and bred in New York originally, at least.
That's
And
right.
is if we're sort of going back to when, how, and why you decided to pursue a career in law. And end up in the special sit space. Was that something that you decided yourself? Was it, your parents that sort of had a big say in it? Was there anybody else involved? How did you sort of, make that decision?
Well, like many of our colleagues in special sits, there were twists, turns, accidents, and interventions along the way. When I was graduating from university, and I went to Cornell University, I was really looking at two different paths: either going to law school or becoming what's called a graduate assistant for football, for American football, and decided at that point, did not get actually applied for a graduate assistant position at the University of Miami, which I did not get, and did get into Fordham University School of Law, and decided to head down that path. Um, Graduated from law school in May of '99, which was right at the top of the kind of .com frenzy. Decided to go work with a friend on a startup, much to the chagrin of my parents, who thought that Chadbourne Park at the time was a better option than not making any money to go work for a startup. Turns out they were right. And as you probably know, in May 2000, the NASDAQ crashed. And the NASDAQ and the companies, the internet companies, the early internet companies all got revalued at that point, right? And it went from eyeballs to a cash flow metrics. And if you weren't cash flow positive, you were or on that path, you got blown up. So we got blown up, and it's March, April 2000, and I've don't have a law firm. I've gone into startup land and failed the first of many failures. And
But so what was it that the startup was about? And maybe just for my education, sort of the other path to Miami. What exactly would that entail? Would you play football yourself at that
so
level, or would you be part of the team? Because I
no, so
saw that
a
you
graduate
did
assistant.
varsity football in secondary school, right? So
Yeah, so
that's
I played what's called sprint football at Cornell, which is NCAA football with a weight limit. And believe it or not, back when I played, the weight limit was 159 pounds. So we had to weigh in like a wrestler Wednesday night before a Friday game at 100 and cut weight to 159 pounds. And then you'd play Friday, and you're probably in the low 170s. And it was, at that time, it was Cornell, Princeton, Penn, Army, and Navy. And as you can imagine, the academies were very, very tough teams. And so that's what I played while I was studying at Cornell. And
And that's a
applied.
contact sport, right?
Absolutely. It's full pad 6 days a week. And it's currently called, and you can look it up, folks, it's currently called sprint football. And now I think there's about 16 universities that play, and the weight limit, I think, has gone up from 159 to 180 pounds. And I thought that I would go and be a graduate assistant, which is the lowest level of assistant coach. And you're starting, and really you're a gopher, right? You're a gopher, you're breaking down film, which is a very important part of American football, and analyzing film and analyzing practice and practice plans. And that was path one for me. And path two was.
And David, so sprint football, same rules as normal football. It's just, faster, or it's on a weight limit, because I assume that American football, no weight limits involved there, right?
That's exactly right. It is exactly the same. It's the same season, same rules, same equipment. And it's an NCAA varsity sport. It's just there's a weight limit as opposed to no weight limit.
Okay. So contact sport, maybe that is a good start, to then further, take you to law school and end up in special sits. We'll judge that later. But that path, didn't go ahead. You then started with your own venture. What was the startup venture about?
It's a great question. And in hindsight, not as much focus as probably a winner should be. And so it was similar to an early type of a messaging board and Craigslist type of um, type of venture, but we didn't get very far. And I found myself in a situation where I had to kind of break back into big law. And I said to myself, okay, I'd gone kind of off the traditional path. Am I still able to get back into a law firm? And I interviewed at three different firms, and I spoke to White and Case, I spoke to Skadden, both on the M&A side. And I had a friend, Jason Cohen, who is now the head of investment banking at Portage Point, who was a bankruptcy attorney at Cadwalader. And he said, Dave, I know you really love business. If you really love business, you should think about bankruptcy. And oh, by the way, Bruce Arinsky needs somebody down at Cadwalader. Why don't you come down for an interview? And I did. And I got the opportunity at Cadwalader. And very interestingly, had I gotten the corporate jobs at Skadden or White and Case, there's a very good chance that I would have been laid off late that summer or early fall as we went into the financial crisis, because it was last in, first out. And the law firms, and I'm not going to speak to Skadden or White and Case specifically, but generally law firms started laying off corporate associates at the back end of 2020, as that first .com recession started. So on the and this will be a theme here with special sits, of how it's been a wonderful career, but I've also been very lucky, and being in special sits has been somewhat of a career hedge to the broader economy.
And what is it, what is it that you knew about bankruptcy and, the wider special sits space? I mean, maybe around that time, a couple of years later, they called it special sits, but it was still odd to have that as, its own practice group. I started like 5 years earlier, and it was very much, either it was in corporate, or it was in finance, or it was in litigation, but it wasn't something that's standing on its own 2 feet. And in law school, I didn't have any courses on insolvency whatsoever. So I was, very much, uneducated on the field, the field of financial restructuring and special sits. what was that with you? And maybe, I'm thinking about, you've just had this experience with the startup. Obviously, you have maybe felt some financial distress yourself. Was that a feature in you actually deciding to go for this opportunity? Or, how were you prepared to actually make that decision?
You're talking about the original decision to go into the
Absolutely.
startup.
No, no, I'm so sorry, David. I'm talking about you actually deciding to go for special sits at Cadwallader and not corporate at
I
the other
really
firms.
owe it to Jason for knowing a little bit about me and my entrepreneurial type personality and saying to me, I know you like business. This is a place where you're really breaking down the carcass of a business and have to be more strategic than in the transactional practices that you're focusing on. And that was really the guidance, and went and spoke um, to Bruce Arinsky, who was from what he had moved over to Cadwallader with a number of others from Waugatschall, which obviously is an excellent historical bankruptcy and restructuring firm. And at that point, being a young person, understanding that I wanted to work with really, just work with great people and learn, and that I'll figure it out along the way. All the answers aren't there day one, especially in special sits.
And what was the first sort of, because you were there for the first 2 years of your career in private practice. Were you involved in, the large filings? Was there, other things that you did? How sort of did you get your feet wet in the space?
Great question. There were two parts to this Cadwallader story, and both very impactful. One, working for Bruce and Jason and companies like Arch Wireless, which and their bankruptcy, which was a beeper company. And if you remember, the Blackberries had just come out, and so those old beepers where the number would show up on your beeper, and then you go to a payphone. The sales were basically, it was a melting ice cube, right? That was a one restructuring that we worked on. Another one was Adelphia, and if you remember, the Regis family, it was a private a company, a cable company that had gone public. They continued to run it like a private company and somewhat of a piggy bank. And that was really my first introduction to capital structure charting and really breaking down an organizational structure and the capital obligations and intercompany obligations. And I really loved that opportunity. And then I also worked with a gentleman named Adam Rogoff on Logian, a restructuring of a hotel conglomerate, who is also from Weil on my first debtor case. So I really got a broad view of different types of bankruptcy matters. Now, there's a great story that the second piece to this at Cadwallader, which is a story that I love about my career and I think is important for young people, is I had just started working on non-consolidation opinions for Cadwallader's capital markets group, which were supported substantive non-consolidation opinions, which some folks either find boring or tedious or less important work. But Cadwallader was really, they are a tremendous securitization firm, capital markets firm, financial engineering firm, and we were breaking down the most basic level of corporate structures and distinctions between LLCs and partnerships and different types of corporate governance and independent directors and authorization to file for insolvency and other um, material actions. I was working for a a junior partner on half a dozen of these matters. And I came in one morning and got a call from a senior partner named Mark Ellenberg in Cadwallader's DC office. He was a brilliant practitioner for many years. And he said, Mr. So and so has departed the firm. I need you to go down to his office and pick up 6 files. And I went down to his office and I picked up the 6 files, and they were Redwells back in those days. So they were literally files. And excuse me, by the time I got back to my office on the other side of the floor, the phone was ringing from the capital markets department saying, "Where are the opinions?" And and this was a moment of pressure. It was a moment of learning. I was either going to, crawl under my desk and depart, or figure it out. And for the next number of months, I really got a fire. What are the words you use? But it was under fire in learning everything about non-consolidation opinions, true sale opinions, bankruptcy safe harbor provisions. And I will tell you that while there was a lot of pressure and it was difficult, that foundation, the foundation of doing that work, really has served me throughout my entire career now, 25 years later. And it's funny, it's one of those practice areas which becomes a theme for me, that it's not sexy. People don't love to do the work. They find it somewhat tedious, or maybe even beneath them in a certain way. And for me, it was really a great brick in starting my career in special sits.
Like the foundation. And yeah, the sort of sink or swim feature is very much there, and time pressure, is obviously a theme as well. And so where did the restructuring group sit within, I guess, Cadwallader? Was it part of structured finance, or was it part of finance, or was it, a group on its own?
No, at that point, it was a group on its own. It was important group. It was a established group at Cadwallader. Cadwallader was always ahead of the curve with respect to the breadth and depth of complex financial practices, and so it was a good place to start. And they were touching a really broad range of financial restructuring matters at that time.
Did you have any contact with the people in London? Because, Cadwallader was one of the first to actually start a restructuring team in London. And, there's a number of people that sort of started in the Cadwallader office that was non-existent at the time, but I think it was sort of like late 90s
No, yeah,
and
we
early
were
2000s.
right there. We were right there. It was Andrew Wilkinson and Lyndon Norley,
Yep.
and Richard Nevins actually migrated over from New York M&A to run a number of significant European bondholder restructurings. So it was and we were doing what we could to kind of work as a team across the pond, which is something that has really developed over my career. Things were much more siloed back in those days, but yeah, it was very much the team in London. That was a office of strength for Cadwallader, right, even back in those days.
Yeah, well, it was a huge success story and sort of, a catalyst for, a lot of things to happen in, I guess, the London and European market subsequently. And it was also, I guess, the time, early 2000s, when the first distressed investors, moved across from the US to London, and it sort of, changed the whole landscape that, made up special sits. So you already had a little bit of cross-border exposure in the first 2 years.
A little bit more of waving to the folks and knowing we had excellence across there. But there was always, from a personal perspective, I always had interest in international work. It just layered a additional level of complexity, both in having to understand the distinct laws, culture, the application of the laws, and how you lay those into a risk mosaic for any type of transaction. So that's something that has always been fascinating to me.
And you, so you had debtor engagement exposure and creditor engagement exposure, but after 2 years, there was an opportunity for you to move across to Kirkland and Ellis, right? And it's funny because one of the guys you just mentioned in in London, Lyndon Norley, who actually is episode 15 for people who want to have a check out on his quite impressive career and the story from him. It also led him to Kirkland and Ellis. I don't know if there was a coincidence there, but how did you sort of make that decision to move across after 2 years?
So had an excellent, a few years at Cadwalader, and came across an opportunity to go work for John Hennis and Matt Cantor, who had also come over from Weill Gotshal to start the New York restructuring practice, or expand the New York restructuring practice at Kirkland and Ellis. And they were working for Jamie Sprayregan at the time, who was in Chicago, and it was, they knew exactly who they were going to be. They were going to build excellence around the debtor and company side restructuring practice, and I thought it would be a great opportunity for me to really go deep on that part of the practice. And from the debtor side, more so than the creditor side, you see the full field, right? And from a perspective of being, sometimes people refer to as the quarterback or sometimes the general, but having the opportunity to train from a debtor's perspective, I think it is, from a lawyer's perspective, it's probably as close to kind of the CEO type seat that you're going to have in any position across law. You really, as you know, in developing a restructuring plan and a Chapter 11 plan, you need to take into account all stakeholders, right? So you're dealing with everything from creditors to employees to outside vendors, and everybody that's involved with the company. And so getting over there and seeing the system that they were bringing, and they really were bringing a system from Weill Gotshal, right, and a playbook that they had. For me, the development opportunity was tremendous, and that proved correct.
And it was very much the preparation for Chapter 11 filings, or was it a lot of advisory outside of Chapter 11 as well?
So as a third year, right, my role was on a team that was implementing a project plan to prepare companies for Chapter 11. That said, and one of the things I've done, throughout my career is be a fly on the wall and listen. And I observed, how certain lawyers, you would be speaking to a company or speaking to a board that was not ready to understand the depths of their problems and the need to restructure and prepare for a Chapter 11 filing. And I think strategically watching counsel allow management and boards to take the time to bring themselves to reality when they had it, when they had that amount of time, and then work collaboratively with their counsel to prepare for a restructuring.
Yeah. So it was a lot of further getting experience on the debtor side, all the various aspects that you need to work on in order to be ready to do a Chapter 11. And but you've been from day one, a dedicated restructuring associate. You didn't sort of circle to other departments, litigation a seat or corporate a seat. You've been sort of from day one full on in financial restructuring.
Well, I'll tell you, I was always had that corporate bend, right? In U.S. restructuring, you've got to do everything at some point. It's important to train on everything. But I was always a transactional type of attorney. I knew that that was what was interesting to me. Um, but at a firm like Kirkland Ellis, you're going and you're taking depositions, you're doing litigation training, and I think the opportunity to participate in some of those assignments and some of those trainings was really important as I moved forward in my career and had to manage litigation counsel and manage litigation as part of a restructuring. So, I'd always say, in restructuring, it's so broad that you spend a few weeks or a few months learning a certain area and you feel like you're starting to get traction. And then you immediately go to your next assignment, which is no correlation to the first assignment. And you step off the curb, and just like in London, you look to the left and then you get hit by a car coming from the right. And that's how I describe, to all young associates. I walk them through that, and I say we've all been there. But if you stay in the game and you keep working, it's worth it. And then when you get to be a more senior attorney, you can actually be an advisor and provide counsel because you've seen enough and you know what it's like to be uncomfortable. And I think that's another tenet of restructuring, which is comfortable being uncomfortable, right?
Yeah,
That's what it is.
out of your comfort zone on a permanent basis and not
That's right.
being phased
That's
by
right.
it. And so it's interesting because your debtor side, so your company side, but the next move in your career is to a firm that is primarily focused on helping, I guess, distressed investors, finding opportunities to invest. And, that is obviously maybe taking one step back and looking from the, London, Europe, the UK, and the rest of the world to the US. That is sort of, the leading light that the US always has been. Chapter 11 was there, you could restructure, but there was also a secondary market, and there were professional players in the secondary market that, had a whole dynamic of, I guess, rescue as opposed to plain liquidation, which we've seen, for a long time in the UK and Europe and elsewhere in the world, has changed, dramatically in the 2000s and where we are now. But we're talking here early 2000s. It was very much the US that was doing and leading this. And the firm that you're going to go to, is doing everything for them, but you actually were doing everything for companies at Kirkland and Ellis. How do we bridge that?
No, it's a moment of clarity. It might even have been one of my first mature moments of clarity. I'm at Kirkland Ellis, and I am working with just incredible people at an incredible law firm. I am really blessed to be working with guys like John Hennis, who is really, watching him, observing him as a professional, a really important part of my development, and great team that was over there at the time. Lisa Lakaitis was over there, who's the head of Millbank. Edward Sassauer was in the group. Michael Frischberg, Michael Cohen, Bob Burns, a tremendous group. And I'm not having fun, right? And I know that the breadth of this work and the mechanic of prepping the debtor case, it's not moving at a pace that syncs with my inner drum. And I recognize that, and I recognize that it was me. It was everybody else was great. It was me. And I had an opportunity to go. Michael Cook, who is the head of the practice at Schulte Roth and Zabel, had just hired Adam Harris, and they needed something. They needed somebody to come in and take a handle on their bankruptcy opinion practice, as well as be a part of the restructuring group. So I went over there with two mandates, right? One was to service their structured finance and restructuring practice and get some organization around their bankruptcy opinions. And the second was basically to be an everything bankruptcy attorney on for their creditor side practice. And that's how it started. And we went over there, and their client base is all alternative investment funds doing all types of opportunistic credit, loan to own type strategies. I'm working for Larry Gelber, who's passed, who's an excellent attorney. Michael Cook, Adam Harris had just come over, and really, I immediately am having fun, and the speed and the number of transactions. They had a gentleman named Paul Watterson who was running their structured products group at the time, who was just doing it on an A+ level, and we're in 2006 and 2007, and the winds start to change, and we're getting calls from our clients who, remember, our clients are now the buy side. They're the clients of the investment banks,
Yeah.
right? And they're starting to focus on protection of their capital and their positions and counterparty credit risk and all of those types of things. And the next thing you know, Bear Stearns, right? The Bear Stearns hedge funds start to fall, and they get um, they
Called up.
they get called off. Then we're in the summer of 2008, and things really start to get bumpy and chippy. And right at this time, um, Adam Harris comes into my office and says, there's a piece of our practice, and he analogized it. We analogized it to the opinion piece at the time. It was a silo. He said it's secondary trading, and I need you to take a look at this, and I want you to, grab command of this piece of the practice. And it was secondary trading of loans, on LSTA type documents. It was claims trading, bankruptcy claims.
Loan Syndication and Trading Association, the U.S. sort of
That's right,
association
the
dealing with
U.S.
that.
side of
Yeah,
the world, which we will get into, the Loan Market Association,
yeah.
which governs Europe, Middle East, and Africa, and that type of market. And as you know, what happened next, Lehman files,
Yeah.
right? And immediately we are bombarded we have clients that have exposure. They have prime brokerage accounts and different types of counterparty exposure to Lehman. And we are also, our clients are opportunistic credit funds that are looking to buy claims. And I'm going to leave the name out of it, but this is still in my career one of the most impressive trades that I've seen. So Lehman files, I think, in September
Yeah, 15th
2000.
of September, 2008.
So late September, I get a call from a young German lady who's a portfolio manager in London. And she says to me, I am going to be buying Lehman claims across the structure and across their entities. And each evening, I am going to send you the preliminary documents and purchase and sale agreements for these claims. And by the time I hit my desk in London the next morning, I need comments and I need bullets, and I want just high level, just the most important critical points.
And
And
these were these loans, bonds,
these
other
were
claims.
claims that were backed up by, they could be a structured product termination claim, they could be a loan, they could be any kind of commercial claim against Lehman, both in the United States and in LBIE Lehman Europe. And
So
they
this
start coming.
hybrid.
That's right. They start coming, it feels like it's a half a dozen a night. And I'm going through, and I at that point had really um, delved deeply into the engineering of purchasing and selling claims and the important counterparty credit risk issues that come up in buying a claim and validating a claim and making sure that you're going to get what you think you're paying for. And importantly, and I'll take a side note on that point, there is a tension in the claims trading market between what a buyer wants to buy and what a seller wants to sell. A seller of a claim, let's say you have a plumber that did $1 million worth of work at Lehman headquarters. He wants to sell his claim. He or her wants to sell their claim and be out, whether it's 10 cents, 20 cents, 50 cents on the dollar. When they sell that claim to an opportunistic credit fund, they want to take the 50 cents on the dollar and they never want to hear from anyone again. They never want to see another document again. And they want to move up and they want to go right their next job and go back to being a plumber.
Yeah.
What the buyer wants is that $1 million claim recognized in a certain category of claim by the bankruptcy or insolvency estate. And they
Yeah.
expect the seller to stand behind whether or not that claim is going to be recognized properly. So there's this gap between what a buyer wants to buy and a seller wants to sell that permeates that market in every single trade from beginning to end. And
Yeah.
that's part of what I'm breaking down for this young lady each night is what kind of diligence do we have, the counterparty credit risk. And she starts essentially not
And
paying as much.
David, maybe to interrupt, and so counterparty credit risk is really the risk that you as a buyer have against the seller, right? But the other risk that you're talking about is, I guess, the nominal amount risk of the claim, right? How much will that claim be recognized in the bankruptcy? Are there grounds to challenge it because the documentation wasn't right, or there was something that sort of Lehman could bring up that reduces that claim, and the plumber is the one who knows that, and you're a seller don't know that, and that's why you want to drag him by his ears and make sure that he's still around if there is pushback on the claim, right?
It's exactly right, Peter. It's exactly right. And those types of issues, that $1 million claim, as you go through the claims reconciliation process, there are a number of times that a debtor's counsel are going to review that claim, potentially reject it, potentially reduce it. And then the question becomes who's responsible for that rejection or reducing of that specific claim, right? In the classification of broader claims that will ultimately be planned for.
So that is, I guess, part of the analysis. The third, I guess, leg to the stool is really, what are you going to get on that claim, assuming that that claim is actually, recognized, and that it, requires you to have some sort of analysis on the complicated structure of the Lehman collapse, and what distributions are going to be made, etc., etc. Was that something that you're also focused on, or was that actually something that the lady did herself?
Great question. We will be part of certain data points of ultimately that financial model of what is the recovery going to look like? What does the recovery waterfall look like? What does appropriate classification look like? And in early parts of a case, your guesstimates, it's very high level guesstimates that you're taking. So we're looking at individual claims. We're running down and confirming an organizational structure, a capital structure, who's owed what, who has priority and seniority, who has an unsecured claim, who has a security interest. All of those things are coming into play. And what I realize as I'm going through this process with this young lady is that she is taking a portfolio theory approach to the claims. So she has already reviewed her recovery model and made a determination as to what the where the line is going to be with respect to the recovery in specific classes of claims. And she believes in her recovery model so much that she's willing to take a portfolio approach across the individual claims. So if she buys $100 million claims and a few of them go bad, and on a few of them the counterparty credit risk does not stand up when when she goes back to the plumber or the seller to recover, based on the portfolio that she is putting together, she's still going to do very well. And guess what? She was right. And so we're buying claims at 13, 15, 20 cents in the dollar, and you know how this story goes. As the estate comes into play and recoveries come into play, those recoveries start getting marked at 50, 80, 90, 110. And it just was a tremendous moment for me as an attorney to watch a portfolio manager um, really have conviction and skill in breaking down a capital structure in chaos and taking a position. And I think, we've seen that, that's what claims trading is all about in a nutshell. And look, lots of others came in, and that trade, and the Icelandic banks trade, and the Bernie Madoff trade went on for a number of years, and a lot of folks did very, very well, and entered it kind of after the market was really marking these claims and providing levels for these claims. But, folks that are brave and have conviction and intelligence and come in early oftentimes are rewarded.
But this is 2008, right? And Lehman is in many ways unique, right? That is just an incredible demise, complex, and it created its own market within the market. The Icelandic banks that you mentioned, Karp, Glitner, and what was the third one again? Well, there were a couple of the Icelandic banks that sort of all faltered around the same time. That market of trading, was different from Lehman, and then I guess Madoff again different from Lehman and the Icelandic banks. How does that actually, develop? Because you were referring to the LSTA trade documentation that you have, but that's for loans, right? If you have specific claims like the ones you've sort of identified and we discussed, that doesn't fit very nicely. So is it that it's becoming bespoke for each claim? Well, that's very expensive too. How does that work?
Well, it's bespoke for each situation, right? Each situation has specific metrics, specific distinctions of counterparty credit, and certainly um, early in a case, um, you have to cover for most risks as a buyer. So, for example, if we bring forward today a big claims trade in North American market, or these tariff claims against the United States government, and what has happened is very early there's tremendous complexity in what recovery could be, who it was going to be paid, reasons for defenses against those claims. What if the claim in the name of the tariff holder, could it be transferred to a buyer? All of those things had to be broken down. A year into this, we're now at a point where there's been a court decision, there's been a process set up for refunds, right? So it's a much more, these markets over time become much more stable and clear. But the early adopters, the early traders that are going out and buying claims, you've got to build a document and you've got to try to get to the edges of the document of where you're really only buying the recovery on the claim. And that creates a tension with the seller of the claim that whether it's 10 cents or today these claims are trading at close to 80 cents, and they've moved very quickly from a 10 to 15 to an 80-cent mark. You have to be able to prepare your own documents and do your own analysis if you're early.
Yeah. And the time you're talking about is sort of 2008, and then up to, I guess, 2015, 16. A lot of trading going on at that point in time, but things change with the banks then as well, right? Because you had prop desks at banks. There are no prop desks at banks anymore. You had small boutique firms that did lots of volume trading, but if it becomes complex, you may need bespoke help. How did that market sort of develop when you were asked by Adam, look, this is a piece of the puzzle that you will need to sort out. Go and build a business around that.
So it was very interesting and very different from today, but in a lot of ways it leads to where we are today. And so you have at that time senior secured bank loans had oversold in late 2008, 2009, meaning that while these were the senior most and most protected obligations of a company that were going to get paid first. A lot of loans that were clearly over collateralized and were going to get paid in full traded down into the 60s and 70s, creating a tremendous opportunity for leveraged loan traders that were looking at distressed and opportunistic credit opportunities. At that time, there were two things that were very different from today. One is, as you just mentioned, the prop desks, that your sell side investment banks would take positions on their own balance sheet as opposed to just flowing them through. So whether it was UBS or Goldman or Deutsche Bank, they would buy those loans potentially for their own book or sell them through. And
And market make, basically, right?
right, that's right. You might have in those days $250 million investment fund, a $500 million investment fund, and you could come in and be a portfolio manager at your desk and do your analysis. And the sell side salesman would call and say, hey, I've got a $10 million piece of Visteon, or I've got a $5 million piece of this. And oh, by the way, here are 10 buddies that are down the block, have all taken their piece. And there's a group that is working with the company on a restructuring collaboratively. Would you like your slice of the pie? And buyers would say, sure. And they did their work, but they also took comfort that they were side by side with many others. And they did incredibly well in that 2008, 2009, 2010 period. And you know this because you saw this on both sides. It was leverage loans, and we'll get into the difficulties and distinctions between the European leverage loan trading market and the US market. But what happens when you're really successful in those periods is that you go out and you raise additional capital, right? So if I did really well and I had 250 million, why can't I do the same thing on $1 billion? And the expectation, the U.S. story at that time was look at the maturity wall for European leverage loans and non-performing loans. And there's going to be this mass opportunity for opportunistic credit from your 2011 to 2016 vintage, and everyone should continue on the trade and continue raising money. And that's what happened, and that's what they did. And as you know, I myself, I think in 2010, early 2011, started working with my Schulte colleagues in London, and we hired certain team members over in London to pursue the European market. And the road ahead looked very rosy for opportunistic credit buyers at that time.
Yes, but there are differences, obviously, and I guess liquidity is a big piece of it, right? If you have a large situation, there's transparency, and there is, uh, 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 a framework around the trading. That's one thing. If you need to source things, and there is no liquidity, and it's a little bit more, opaque. It's a completely different thing. And in Europe, we don't have one legal system, one insolvency law. It's all the various jurisdictions with their own insolvency laws and their own peculiarities with, enforcement on security and what have you. So it's slightly different from, I guess, the US market, that is the starting point for the secondary market that we're talking about, that sort of came across the pond.
Yeah, it's very different, and in a lot of ways, it's harder, and culturally, it's distinct, right? And the Europeans very much viewed and still view their corporate bank loan as a private club, right? And with access to certain types of company confidential information that they didn't want just floating out there to any old investment fund. And so the opportunity to trade into a European large corporate situation was much more difficult than in the US. The definition of eligible assignee, or who can become a lender, was much more in control of the borrower across European situations than North American situations. And so what we started to see early on is a portfolio manager would go right in and say, I'm going to take out a 40, $50 million chunk of a European issuer, and then they'd get rejected by the company as becoming a new lender. And they were stuck as a participant, because when you enter into a trade to buy a piece, whether or not you can close the trade does not determine whether or not you have a valid trade. When you agree to a trade, you need to close the trade, whether it's by an assignment where you step into the shoes of that seller, or a economic risk participation, or some type of cash settlement. You're on the hook. So that was one of the earlier moments where we would see U.S. portfolio managers start to understand that they now had a $40 million exposure to a company where they were not going to have a seat at the table. They were going to have no voting or control rights. And in fact, given how European risk participations are structured under English law, they were now going to have the counterparty credit risk, not only the credit risk of the company that they were lending to, but the owner of record that they had purchased the participation from, because English law participations are distinct from New York law participations, and they're derivative instruments. And so that was piece one of Welcome to Europe for a lot of the New York traders. The second piece was um, the float as we get into 2011 and 2012, and those $250 million funds are now $1 billion or $2 billion. The float wasn't really there, right? It was that there was this term, a maturity wall on roller skates, because of where interest rates were and the ability to refinance at the time. And so I remember, Peter, being in a DebtWire conference in London in 2013, And I was sitting there and observing a lot of the portfolio managers and the presentations, and someone stood up and said, where is the paper? Where is the opportunity? We're talking about all of this opportunity, and they had invested time and resources. But what was happening is the same way when we started our conversation, we were talking about the sell side desks serving up 5 and 10 and $20 million pieces. They weren't able to do that as well in Europe, number one. And number two, because all of their competitors had also started to get larger, the ones that had their own conviction were taking down the entire pot. They didn't need 10 friends, right? They had gone from $1 billion now to 10 billion. And so instead of leading the way and letting 10 friends have a piece, they
You
were
deploy capital.
they're taking the entire piece. I
Yep.
don't need your capital. And those smaller shops were shops that had analysts but not sourcers were getting boxed out.
So single names in Europe, you sort of described the issues, and there were reputational issues still with, distressed investors being called vultures and locusts and, all negative stuff.
Americans.
American, yeah. Well, but again, I think things have further developed, and what you also were referring to, the relationship driven banks. I mean, the stage has changed. The banks are still there, but they not have the prominence as they used to have, and the new players, the funds, okay, there were a lot of funds starting. A number of them have gone back to the US, but a number have also stayed, and there's homegrown funds, and it is a part of any restructuring over here as well, that funds are there, and it's having them there makes it more professional in a certain way, gives more options to restructure. But what I do remember around the time that we're talking about 2013 and 2015 was that at that point in time, all the banks in Europe were, in trouble. And there were huge non-performing loan portfolios that needed to be sold. So it wasn't like, we're not going to do it. You have to do it. And obviously, subsequently, there were, capital requirements that, were an incentive for banks to actually sell their NPLs. So there were these auctions, NPL auctions, and the funds, the clients of Schulte Roth and Zabel were interested in participating in auctions, and you did, quite a number of those. What were the dynamics there?
Yeah, and look, and this is again a theme we're going to talk about in a little bit that is coming out today. You had these great big portfolios of loans, but ultimately, how are they going to get worked out? One at a time, and somebody's
Yep.
got to do it, right?
Yep.
So the opportunity to this is where you went from traders and analysts to servicers and restructuring shops. And so what you were seeing is the firms that were really successful in the portfolio trades had the ability to manage servicers and workout professionals and enforcement professionals, and not just traders, right? Getting past the concept of where it was a liquid economic instrument. And so you start to see the haves and the have-nots from the opportunistic credit funds, and you start to see certain funds realizing that maybe they don't have the chops or the breadth or the European on the ground connections and folks to participate in that trade. But for those that could do it and were comfortable partnering with local servicers, there was a tremendous opportunity.
but it was a very competitive space, and there were, a couple of big players that basically, competed for all the portfolios that were there. Um, and NPLs, maybe have a broader view on NPLs as an issue. Uh, um, we were focused, and we're talking now about Europe in particular. Obviously, the US had, NPL portfolios as well, but it is a problem in Africa. It's a problem in Asia. And do you think that the experience that we've had in Europe, in particular, as a knock-on of the great financial crisis of 2008, that the portfolio sales and also the bad bank structures where the banks could actually transfer their NPLs to a newly created bad bank that then would facilitate the auctions of those NPLs, are those, looking back and sort of with hindsight, are those tools that we could easily, quote unquote, sell to Africa and Asia in jurisdictions where NPLs are a problem as well? Or do you think actually we've learned from it and it's a lot more complicated and it may actually not translate very well in different parts of the world? Do you have any views on that?
Like my view is that the structure worked, right? And that you have to a restructuring or dealing with the stress in your portfolio can suck so much oxygen out of the room that you're not focused on running your business. You're not focused on any forward movement. And I think there was a tremendous amount of learning for portfolio managers across opportunistic credit in the last cycle in Europe, and those complexities and understanding individual laws, individual cultures, servicing culture, all needed to be taken into account to be successful. And I think what you have then today is you've developed a number of players that are comfortable, but they're not just comfortable, they're proficient in going into a new jurisdiction and and acquiring and then enforcing and breaking down those portfolios. So I do think for that, that group of investors, I think that is a structure that could work and could be deployed in Africa and in Asia and similar type opportunities.
But what is it? Because it hasn't happened yet, right? I think they're struggling with their NPLs, and I guess the World Bank is helping them, trying to figure out what framework do we need to put in place. But in my mind, a lot of things are also dependent on, as you say, culture and the mentality that you have within the jurisdiction. A lot of those, I guess, African jurisdictions, financial distress is still very much criminalized, right? And that has a huge knock on as to how people on the ground deal with financial distress. They're, rather running away from it than admitting that there's a problem and looking at tools to actually resolve it and either liquidate it efficiently or, rescue it. The clients that you're talking about, the distressed investors that are interested in NPL portfolios, they will assume a certain level of professionality in order to actually move into it, and a certain size, because it's also gonna, it takes time. There is like, an upfront cost to do that, and you need to have transparency as to, the portfolio that there is. You need to be able to check something, right? Even though you may have a portfolio view on it. Do you think that those elements that are essential for, I guess, the secondary market to kickstart in those jurisdictions is anywhere near there? Or are we sort of, stumbling over the first hurdle there?
Well, if you remember, if you look at the European market today, it is so much more mature and light years ahead of where it was in the time that we're talking about in 2011 and 2013 and 2015. And you've got to have it's patience on both sides, right? Both sides need to come along, both the investors, I can speak for the investors, um, having gone in and in some ways been successful, in some ways not been successful over time, which creates your next success. So I think the investors are patient, and ultimately the culture is also, there has to be a meeting in the middle somewhere, where you have a willing buyer and seller. You know, I hesitate to put a time on when that will take place, but I think that, you know, it will at some point.
And what are the key, almost non-negotiable things that need to be there for an investor to actually want to spend time there in another, I guess, market that is untapped? And as you say, Europe was sort of in its infancy. At some point, it has matured. Other markets, you need to get an entry point. Is it the size of
You need
the
size,
loan?
you need size, you need an understanding of how the rule of law is enforced or not, right? Doesn't have to be perfect, but you need to understand what the rules of the road are, and ability to have local partners that are reliable, and that's really where you start.
And a willingness, I guess, of banks to want to part with the NPLs they have. And maybe if they don't, then pressure from the government and the regulator that they need to do it, so that, there is an incentive to actually bridge the gap between buyer and seller, right?
That's right. That's right.
Yeah. So that's maybe what we need first. So we're sort of, 2016, 17, fast forward to 2025, when I guess a big thing happened in Schulte Roth Zabel. It decided to merge with a much larger firm and become, a mammoth firm as a result. Uh, that was different from the firm that you, joined in 2006. Well, what was the practice going forward that you sort of developed, because you were very cross border when we were partners at Schulte in 2013, 2015, 2016. But then, as you say, things have changed subsequently. Have you become more stateside, or has it been cross border but in a different way?
Yeah, no, it's a great question, and in my view, there's a couple things that happen, right? Number one, as we're getting into 2015, and the seasoning of the professionals and the commitment of funds, law firms, and investment funds across Europe really is maturing. And so the ability for a portfolio manager or a lawyer to really be effective on both sides of the Atlantic is more limiting, in my view, than it was in 2000, 8 and 9 and 10 and 11. That's number one. And so that market has really developed, and is really mature. The second thing that we were seeing is that all of the funds that had such great success during the financial crisis had grown um, tremendously, right? So 1 billion to 10, 4 billion to 20, and the opportunistic credit opportunities aren't really there in the same way they are. They start to peter out, and that forces these funds to move into other strategies, which, in my opinion, becomes the growth catalyst for private credit, right? That's what that money had to go somewhere. It had to go into lending silos, litigation, finance, receivables, financing, of course, middle market, corporate loans, and all sorts of esoteric financing structure. So what I saw from my side is, yeah, I became much more US focused on both the workout um, and bankruptcy and restructuring and special sits side of things, which that market evolved from a portfolio model where you would have a dozen or 2 dozen lenders in every situation to where middle market situations were often one lender, one captain. They didn't need someone else to make that loan into a middle market type situation. And as you know, in the situations where you did have a lending syndicate for broadly syndicated loans, we have the rise of lender on lender violence because there's not enough to go around for each participant. So the market really, really starts to, in the mid to late teens, the market starts to change. And I think professional behavior and where professional engagements were coming from had to change as well. Now, at Schulte, we had always said we're in New York, London, and DC, and we will be your strategic quarterback anywhere in the world. And that had served us very well for a long time. And at least for me personally, and I don't speak for the firm, I speak for myself. In the post-COVID era, things started to shift. Things started. It started to feel like you needed to be bigger, you needed to be broader, you needed to have more depth. And I think that's the first moments, those 2022, 23, where Schulte starts to, at least I and some of my colleagues start to say, is this chassis going to be the chassis for the next 10 years? They had achieved tremendous excellence in investment funds, as you know, in fund management, both in the US and in the European market and the London market. Really great specialized practice in direct lending and restructuring and structured finance, but their competitors really started to accelerate growth in lawyer count.
And maybe that brings us to where you are today. You've joined another firm, but a firm that has a large footprint within the US. Maybe you can say something about your thinking about this most recent move in your career.
Yeah, so early in 2026, I decided to move to a US firm called Polsinelli. Polsinelli has 1,200 lawyers across many financial centers in the United States, and importantly, for the time being, has made a determination to stay a domestic U.S. law firm. And the focus is it is a Kansas City-based firm. If you know anything about the center part of our country, there's a great connection between Kansas City and Dallas and that part of the country. And we're focused on really the up and coming financial centers in the US. So New York is there, Miami, Fort Lauderdale, Texas, they're in Dallas and Fort Worth. Um, Los Angeles, they're in Nashville, and they're growing. And really, it is a firm that has achieved excellence in middle market M&A, in real estate, everything from dirt to structured products, healthcare, which is a critical industry in the U.S. And now we're really focusing on the build out of middle market, private credit and capital and restructuring. And that's really, for me, it was an opportunity again to make a career shift and decide what I wanted to focus on for the next 10 years, and really looking at, private credit facilities, the size of those facilities, and the structure that's going to be client friendly for those types of names. And so Polsinelli has a really excellent middle market corporate client base. They have do lots of works for different regional banks. We're making headrows into uh, private credit and investment funds, and it's a great it's a well run firm. It's a young firm and a real focus on kind of where the ball is going to be.
Well, that sounds, very promising and great. One thing that I'm sort of, if I try to zoom out on, we've sort of went from 2000 all the way to today. A lot has happened, in that space of time, both outside of the US and within the US. Um, what is sort of the biggest change that you've seen in the US and in special sits market in the US? As I said, earlier on in the conversation, I think for a long time the US was sort of the leading light for the rest of the world in rescue, restructuring, dealing with financial distress. But I think various jurisdictions have learned from the US, have now, come with their own tools in the toolbox. And I guess, globally, on a geopolitical level, things have changed. There's a lot more uncertainty, and then I think one case in particular that sort of seems to be the start of maybe something to come is the fossil case, where a U.S. company in Texas decides to actually not use the US Chapter 11, go to the UK and do a restructuring plan there, because under the documentation they couldn't get the level of consent that they required for the restructuring. They go to the UK and they go via the Chapter 15 back to the US to get it effective in the US. And it's sort of almost something that in the past a lot of jurisdictions, a lot of companies outside of the US used, in the same way, the US as the place to restructure. Now it's sort of the reverse. Do you think that that is, something that is there to come? And does that require the US to maybe think about a Chapter 16 to sort of, adjust their own Chapter 11? Any thoughts on that?
Well, I think what it shows is the maturity and skill and breadth of restructuring departments, right, both domestically and all over the world, and the collaboration that you're seeing between restructuring professionals. I think it's a full circle moment for restructuring professionals, but I think it's also it demonstrates that great professionals understand all of the tools in the toolbox and not just the ones that are naturally um, in front of them. And I think what I'm seeing more, and that you just cited a great example of kind of taking the solution across the pond and back. What we're seeing here on a more regular basis, and that's a unique situation in some ways, is it's a capital solutions practice, right?
Mhm.
And so today, my first, second, and third option have to be some type of out of court solution, potentially a liability management exercise, or potentially some type of, prearranged case that is going to get through a formal proceeding much quicker because of the cost and expense. So when we're talking about kind of what has changed, I think the expectation of your restructuring professionals is that their financial engineering skills alongside of the restructuring advisors and investment bankers that they're going to work with really need to be top notch. And I think for me, that's what I'm looking to bring to the client base that I serve right now, and the matters that we serve, is making sure that when we come to a situation, we're prepared to present a range of potential outcomes.
Yeah, understood. So, if you look back at, I guess, what is the good 25 years in private practice that you have had, uh, um, I think you sort of explained the full-on nature of the special sit space. It's not sort of a 9 to 5 job. How has that sort of affected you, your life, and how do you sort of deal with that aspect of the practice? And do you still have a life outside of the life of private practice? How do you balance these things?
It's a great question, and at different periods of life, you do a better job balancing than at others. But I think I was incredibly blessed and lucky to have a great 20-year chunky run at Schulte Roth Zabel with my assistant friend and counselor Pamela West, who
Yeah,
very well, who's now joined me at Polsinelli, and I'll talk about her in a second. It's important that um, we do, but when I was transitioning over and made the determination to move over to Polsinelli, I talked to my family and also thanked them and said, I understand, I'm very lucky and I'm grateful for the 20 years that I had at um, Schulte Roth and Zabel. And I also want to thank you because I know it impacted you, right? And there's a saying in the practice of law and in restructuring specifically, right? Everybody understands and appreciates how hard you work until it impacts them, right? And
yeah,
it ruins, their plan or their spot that you're supposed to be, or you're supposed to have undivided attention. And I think as I've become more senior, I've become more aware of that, and needing to be present where I am and manage one's health, right? And proper exercise and eating
yeah,
and things are all critical. But it's a it's a real piece of the puzzle, and everyone has to make their own peace with it in some way, and find their own seat in being successful. And on that note, I also want to say, you know I had a partner, um a real special partner in my practice, that we connected on the first day that I walked into Schulte Roth and Zabel in September of 2006, and that was Pamela West. Her married name is now Pamela Budd. Um, a really incredible executive assistant that had experience in banks and other large law firms and knew her way around these complex organizations. And we have worked together for 20 years, and admire her and the professionalism that she brings to our practice every day, the ability to handle uh, complex clients, to interface with all different parts of these large firms. And having a partner like that, I always say to people, I wish you one work colleague like that in your own career, because it's really been special.
yeah. And it's sort of work wise and on the human level as well. As you say, sometimes you sort of need to experience it in order to, listen to it. I mean, we're all forewarned when we start that this is, stressful and what have you. And, personally, I, for a very long time, thought, look, nothing's going to, happen to me because I do everything with the right intentions and it's going to be fine, right? But yeah, intentions are in my head, actions are what you can see. Others have another view on the same thing that you're doing. You do it with a certain intention, they view it quite differently, right? And sometimes you need to just, learn that in practice and adjust yourself accordingly. And in my mind, there's a balance that you need to find. But like life, the balance always changes. So, what is the right balance early on in your career, mid career, and late career is completely different. So you need to just, adjust to that and be open to that adjustment. But it's not always easy, especially
And yeah,
not in our.
I think it's fascinating to speak with, as your children get older, and you have a relationship with your spouse. It's fascinating to listen to them and hear the positives and the negatives and
Yep.
how your career has impacted them and what they've picked up as being a fly on the wall from those conversations and the car, and these days it's the car rides and it's the different things. But I have a very supportive wife. I have three incredible teenage daughters that are on their way and are doing the right things. And I think they've picked up some good things from me and thrown away the bad. And then a young son who is also, doing great. And I think, where I've come from is I remember the stress of being a junior associate, and there was that clicking moment of if I'm going to survive here, I've got to enjoy it and be comfortable being uncomfortable. And I think that was a real shift for me. And so today, as I go through, and of course we have our moments where it's too much, it's stressful, but I really go through each day with gratitude for my colleagues and for what I'm learning and from the clients, and just try to look at the blessings that come with this type of work and the interesting things and the people you meet and the learning, and there's a lot there, and there's a lot to take from there, and then to share that wisdom and experience with your family.
Yeah, no, I couldn't agree more with you. So how do you explain to your kids what you're doing? Oh, they should listen, obviously, to the podcast, and hopefully it will become clearer. That is actually,
I
one
think
of.
this is going to be a wonderful. This is a wonderful reflection of the road. And so, Peter, I appreciate the opportunity to do this with you and record it for posterity. But I got a note as I was departing Schulte. I got a very nice note from one of my colleagues, and I thanking him for our years together. And he said, it's been a great run, and you were always there for the messiest, most complex situations, and that's what special situations is, right? It's when there's a real mess and there's a real difficult situation that doesn't fit in a box, and a company's going bad. We step in and settle things down and figure it out. And I think people that thrive in that environment are really going to love a special situations career. And I think for myself, I have found that those truly are my best moments are often when a company or a lender or the structure is at its worst and most chaotic. And I really enjoy being a counselor that can be depended on to find a path forward in those moments.
So how do you stay calm then? So that is one of, because maybe just taking one step back, what are the characteristics of, somebody that has longevity in this space? One of them you've already sort of highlighted is being comfortable, being uncomfortable, right? But the other one is, yeah, staying calm and, be able to make decisions under time pressure and with, I guess, imperfect information, right?
Look, I think those are the moments where you're, providing care for your client and for a situation. And, myself being, a competitor, that it's a finding a path forward. And if you don't stay calm and you don't, take in all of the data and try to find what is the very next step and the next good decision that you're going to make, you're not really going to be helpful. And so that's really, I try to take, and in each one of these situations that comes about these days, you're building on that 25 years of experience. I had the opportunity uh, to have drinks with Ryan Bennett, who was a colleague at Kirkland Ellis and just moved over to lead Wilkie. And nothing but great memories from our time together at Kirkland, and grateful for all those folks. And he said to me that, there was something about seasoning, and that he was now ready to lead at Wilkie, but he was ready because not only of the skill, but the seasoning of coming into the age that we are in 25 years into a career where you've seen enough chaos and enough of different types of situations that you are ready to be calm in those moments. And I think that's really what it's about, and putting together all of those stories going back to those moments that we discussed at Cadwallader and Kirkland and Ellis and the early days at Schulte, and each one of those twists and turns. One of the things that I have done through my career is each month reflect on my failures and successes and places where I could have done better as a human being, or not, and try to build upon those today to get better. And still, it's always a challenge. There's always failures. There's always ways to do better. But take each one of our restructuring matters, each transaction is an opportunity to learn about a different type of law, a culture, how different great colleagues approach things, how folks that don't do it well approach things, and why they wind up in a bad spot, and then to build your own mosaic of an approach to the market and to your clients.
That's a very mature thing to do, to just, find that time. I have to
Well,
say,
I am very mature, right? You can see I'm getting
no,
up there. And
no, but when did you sort of, because look, I think big law is also, it's a hamster wheel, right? You're running and running and running, and it's sometimes very difficult to, take the time to reflect on things and actually, learn from things, because there's no time. The goalposts are always changing. You think this matter is done, and then the other one matter is and sort of, you'd leave that one behind, go to the next one. How do you, find that moment to actually do that reflection, which I completely agree is essential for longevity, but it's not always easy, is it?
it's not, but I think as you go through the process, and there's constant, you know, and I'll give you an example, right? Just yesterday evening, and we're filming this and speaking in early May. I'm walking into I'm working a very difficult transaction right now, and we're advising a board of directors, and there's a tension between sponsors and lenders and management, and I'm also getting ready for my daughter Kaya's pre-prom pictures all at the same time, right? And it's like, this is, everyone understands this is what it is. And I think at that moment, and there's a couple of very difficult personalities in this transaction, and I hearken back to my high school football coach, who said, it's an honor to be in the big game. Most people don't even get the opportunity to know what it's like to sit in the seat, to be in the big game and enjoy it in that way. And so while there's stress and there's directors and lenders and teenagers asking for money and photographers coming at you from all different angles, take the joke, right? Be say that I'm so grateful to have this, right? And to have this and to have a supportive family. And I think so that reflection, you asked, when do you take time? It becomes part of the process, right?
Yeah.
It's just it's a second, right? Of gratitude and reflection, and and it's seeing there is there are some incredible lawyers on the other side that I'm working with on this transaction that I'm still learning from. There are some folks that are maybe I don't love the way that they're rolling forward in their transaction, and I'm defining what that means, right? Instead of it being a feeling, right? Let's stick to facts. What are there that and those become the foundational pieces of the next matter and the next matter and the next matter.
Yeah. So I guess, this generation, our kids, they're focused on the why, right? Why are you doing this? And what's sort of your why after, 25 years still enjoying what you're doing?
So, Peter, I had an opportunity on Thursday morning to observe my daughter Kaya and a number of her friends present a years-long research project at school on Thursday morning, and Kaya's friend Mark made a presentation on the meaning of work and
Wow.
the meaning of work, and he compared different generations as to what's important about work, what is the meaning of work. And I guess what am I? I'm 1973. Does that make me Gen X or
Yes,
something?
you are. Yeah, because I'm Gen X 71. So, we're
Right.
both
So
Gen X.
we're Gen X, and um, I won't get into the complexities of Mark's presentation, which was excellent, by the way, and what young people are thinking and what they're facing today. But it certainly gave me an opportunity to reflect of what does my work mean to me, and maybe it would be a different career path or different moments, but for right now, um, it's about, learning and providing great client service, being part of a growth story at Polsinelli, which I really believe in their platform as a place where young and up and coming associates and partners can come and kind of step out into the light of their own and make an impact with incredible middle market clients. And remember, the middle market today goes up to $1 billion. So
Yeah.
it's not
It's
small.
not small, not
It's not
small.
small um, at all. And so that moment, that presentation, made me think, what does it mean to me? What is the path forward is to keep learning and to keep also learning about technology and AI and how that's going to be impactful in our work going forward. And I certainly have a view that there are going to be winners and losers in law firms and in many organizations with AI. And you've got to be somebody that, understands the big picture, can come up with strategy, and can execute all the way to the finish line and get things across the line. Because the folks that, from B to C, from C to D, I have concern that those are going to be eaten by technology. So that, really pro- provides one of the next great challenges for the industry, for law firms, for people in general. And it's scary. I'm looking forward to it, but all of the above, it's going to be, a beautiful mess as we push forward into the next decade.
Well, for us, obviously, but it will provide, I guess, another tool in the toolbox that hopefully we can use and do much more with. I think the biggest concern around AI that I'm hearing is that the people that now start their law career and in special sits, how are they going to deal with AI, and maybe even further, the people that are now graduating from high school need to sort of go to law school. Does the study have to change because the environment is going to change? And I think one thing that as a parent I'm concerned about is also the way that I guess social media and everything around it. How are people going to deal with failure, right? Failure is essential in our space, but in my mind, there's only a failure, not to try your best. Everything else, as long as you can sort of, learn lessons from whatever you tried that didn't go exactly right, it sort of adjusts your trajectory. But as long as you can sort of, stay in the game and move forward, nothing is actually, without merit. And sometimes, you learn the most from things that don't go well. But is that a mentality that you believe, the next generation, your kids, my kids, will actually take with them?
Look, is all I'll say. At least for my kids, it's a yes. It's got to be one of the top three things that I preach as a parent is embrace your failure. I, you know, I don't know how this is going to hold up in posterity or across the international lines of your podcast. But I say to all my kids, go out and get punched in the face. And then you drop and you realize that you can get up and you live to fight the next day. And the sooner you do that and realize that you can keep going, the better it's going to be. And I think one of the things that I admire most about my daughters is their courage, right? Their ability to put themselves out there. And I think that it is the resilience and facing failure in the face of, as you mentioned, social media, where everyone only knows success
Yeah,
and
it looks like everybody's doing so wonderful. What
right,
a boring life do I
the
have?
bright side of life. Um, I think that it is that building that resilience and building it early it's always been critical. It's critical to me. I think they have certainly seen my failures personally and professionally, and I talk to them about it, and we'll sit as a family and talk
Is there
about
an
what
example
did I
that you can
learn.
sort of share? Because again, these things I think are so important to show that sometimes, things that you think are completely, a failure in the moment actually turn out to be, having a silver lining and a blessing in disguise going forward. You can't see it at that moment, but, later on, it fits into the picture.
The failures become the seeds of your future success.
That's true.
They do.
Yeah, no, that's right. So if you look back at your career so far, was it a career that you sort of, set out to have? Was there a plan?
Uh, there was a plan to take the next step, right? And there were twists and turns and certain visions of the type of attorney that I wanted to be, and there were moments, uh, in different parts of the financial crisis and different moments today where I'm like, hey, I recognize the spot that I am. I recognize from the vision, but I think it has always been a path of moving forward, learning, trying to surround myself with incredible colleagues, which I have. absolutely done, and learning from folks, and that's what I'm going to continue to do. I think today I find myself in a seat where I'm able to mentor and share some of my experience on the path that I've been on, and share some words of comfort to younger folks that are going through the turbulence that we all experienced if we've survived this far in special sits, and reflect back to them that those bumps and bruises and falling down are just a normal part of the action, but that they haven't. And I think that's really, to me, uh, forging those relationships, and seeing some of the people that have worked for me and on my team have incredible success is really incredibly rewarding.
And so, talking about success, what is success in special sits for you?
That's a tough question. What is success? Is it a transactional outcome? Is it a good year? Is it accolades from your million friends on LinkedIn, right? What is it? What does it look like? I think it's you know being a good partner and colleague to those at my firm. It's being someone that is called upon by clients and colleagues for the most difficult, complex matters. That's when I feel that I have success, when I'm able to step in to a situation for a fund or a bank or a board of directors that is chaotic and not going well, and bring some order, straighten out a path, and being the one that was able to kind of get everything back on track. For me, those are the moments that I really value and cherish the most from a professional perspective.
So, trying to bring order in the chaos is almost like a definition of success for whatever the client is. Obviously you can specify it more to what they're aiming for, what is achievable, but that is first and foremost a job that needs to be done.
Look, in most situations, on most special situations, when you're getting that call, it's a moment of great distress for a board that owns equity in a company, or a lender who now a portfolio company is not paying, or a moment of great opportunity for an investment fund who is competing in a distressed situation with 10 other competitors at different parts of the capital structure, and bringing their own uh, needs and motivations and personalities to the match. And
Yeah.
so each one of those situations presents unique challenges.
So we touched upon AI, right? Is there anything else coming down the pike that you believe will have a significant influence in our space in the next, what is it, 10, 15 years?
I think, technology and law firms as businesses, in addition to being professional organizations, are going to continue to evolve in the space. We've all heard about private equity firms investing in law firms, and how that may work out and change things. Obviously, that's something you saw in the investment banking partnerships in the early 2000s, and that has been impactful on culture as well. And look, I think financial, what has really changed in 25 years is the most complex financial engineering being brought to bear in the transactional space, continues. And the different types of products and structures that are being developed and being part of that. I hope that that continues to evolve. We find mostly effective solutions. Some, of course, will not work and not work out in the long run, but that's something that will continue to be a part of the puzzle.
Yeah. So, and has the profession, given you some sort of what is it, a mantra for life that you sort of apply? Do you have something like that?
Well, yes, and I think it, it's it's something that kind of started, with athletics and team sports, and then has moved into restructuring. And I've always been someone, whether it was football or lacrosse, that really gravitated to team sports that had different players and position. I know you were a rugby player, and
Oh, my no, my sons were. I was, I'm cheering on the sidelines,
but
but I appreciate the sport for sure.
yeah, but it's important, and restructuring is a team sport as well. It's about getting the right player in the right seat very quickly and working collaboratively, as a team. And so you will often hear me, if you're a fly on the wall at the firm, and so and a new complex matter comes in. That's what it's all about. Right players, right seat, very quickly. Let's work together, right? And work as a team. And I think that's kind of what I kind of look at.
Yeah. Um, Look, I think we've gone around the houses and sort of covered quite a bit. Sort of one last question I, ask everybody is, look, if there are young people looking and listening to this, what would be the advice that you could give them if they are interested in maybe, exploring the special sit space?
I say the same thing to everyone that I interview for a junior associate or summer associate job. I'm going to tell you my story and what it is and why this works for me. But ultimately, your success is dependent upon you finding the right seat for you. And then when it comes to special situations, you know, you are going to have to go through a long and bumpy road before it starts to feel good, but it's worth it, and stick with it. And so, what I try to, in the first instance, is tell young people, like, you got to find out, what is my joy here? Do I enjoy complex financial instruments, six-dimensional chess, and the pressure that comes with it? If you can say yes, if you can say yes to that, then you need to have some patience, because it's going to be a bumpy road. But whether you expect to become a long-term restructuring professional, or a portfolio manager, or a CEO of a business, or really anything else in life, restructuring, special sits is a great training ground because of the breadth and complexity. And so that's my message.
Yeah. Wow, that's a great message, and I can fully subscribe to that. Uh, David, thank you very much for your time today and for sharing your story, with us. Thanks.
Peter, thank you. It has been wonderful to see you and to spend some time with you. And before we sign off, I have to, you know, tell you about a quick suspenders in here,
Yeah,
and
that is great.
two guys, two guys wearing suspenders, and I always appreciate, your great braces and your time, and it's been a great couple hours.
Thank you very much.